Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back here at the end of the week with my very good friend who is counting the seconds until he can escape this conversation to make it to his Labor Day long weekend with his family. Lance, how you doing, buddy?
I'm ready to go on vacation. So,
No, I
let's
know,
go.
but you know what? I think folks feel, they missed their Lance last week because we had the really good end of life webinar with the great certified financial planners at your firm, Danny and Richard. So I think we got to give folks a little bit extra today just to make sure that they don't feel too neglected with their the market junkies out there. Look, there's a fair amount to talk about here. There's some things that are starting to really pick up steam here in an interesting way. First, let's just start with the market action this week. It has been an up week for the markets.
Yep.
They're still trading a little bit at the time you and I are talking about here, but they're up about 150-ish S&P points so far for the week. You have been telling us to expect this sell-off that started to probably be a relatively shallow one, probably going to pick steam back up again. Is that indeed what we're seeing here, you think?
Yeah, absolutely. I mean, as we went through the month of August, we had a really good first 5 months of the year, and I find it kind of interesting because during the first 5 months of the year, really, February, March, April, May, June, markets are accelerating. We're up 15% for the year, and everybody's like, "Oh, stocks can only go higher from here. Ain't nothing going to stop this train now." And we were saying, "Hey, look, you're going to have a bit of a correction here." And so as soon as you get into a little bit of a correction, we say 3 to 5%, completely normal any given year. Then you have everybody coming. I was like, "Oh my God, stocks are never going to stop going down again." And it just you've got to have a little bit of perspective and just say, look, what goes up has to come down a bit before it can go up. We talk about stretching a rubber band. Historically, once you stretch it as far as you can in one direction, you got to relax it before you can stretch it again. So what we saw over the last month, completely normal. We got down to really good level support. If you'll let me share my screen real quick, we can just take a look at a chart. So this is just basically kind of a short-term look at the markets going back to kind of July of last year. But you can see we've been in this very defined bullish trend every time that, and really you could draw these trend lines all the way back to October. But we've just been in this very defined little bullish rising trend channel. Markets got really overbought back in June and July. You can see by the lower band here, this relative strength index was above 70. And that tells you that rubber bands, stretched a little bit too far. And this is why we were sitting there going, hey, look, you're going to get a little bit of a correction here because you got to relax that rubber band a bit. And as you can see, we worked off that sell-off in August, worked off a big chunk of that overbought condition. The markets held the bottom of that bullish trend. The top chart is just our basic buy and sell signal. It's turned back onto a bullish buy signal from a fairly low level as far as a normal oscillation occurs. So everything right now is all completely normal, and you're getting this kind of push higher. We broke out of this downtrend that started back in July. So you had this downtrend in stocks. Like every day it was just selling off. Every day the media was like, we can't have more than one day of a rally, and then the market sells off again. It's terrible. That's normal. We corrected back to that support line, and now markets are rallying again. So again, absolutely nothing wrong with the market technically. Fundamentally, it's sure, it's overvalued. There's certainly longer term concerns economically speaking. We're writing a couple of articles on this as we speak. But Jerome Powell did a big favor to the markets last Friday, talking about the fact that the neutral rate really isn't an issue for the Fed. They're not really paying attention to that. Their long-term goal is 2% inflation. And so that's all very bullish for the markets in the near term. And that's why you saw markets responding kind.
All right. Well, keep this chart up for a few seconds here. Sure. So, you've been saying for a good while here, and I'm overgeneralizing, but the bull case is the technicals, the bear case is the fundamentals, and the market continues to look technically bullish here for the reasons you just mentioned. And I do want to give you props. When the market was down at the bottom end of that trading range, you were pointing our attention to both the RSI indicator there at the bottom and the MACD up at top. But you were saying, look, this RSI down at the high 30s here is showing that the rubber band is now getting stretched pretty far to the downside. and you were saying, I expect that it's probably more likely going to start reverting, and you were positioning as such. And kudos to you, that seems to be where the markets have continued to go. So they are continuing to kind of behave in a way that TA would expect them to, right? And look, TA is one of the guidelines you use. It's not the only one. TA isn't a bulletproof predictor of where things are going. I just want to underscore that the market is still behaving technically as expected. And right now, we're in an environment where, again, I'll let you confirm this, but where you think the more likely trend in the near term is higher still.
Well, yeah, a couple of things, and this is always the thing that kind of baffles me about investors in general, and even professionals. When you talk to a lot of professional investors, they're like, "Oh, fundamentals are the only thing that matters. Technicals are voodoo. It's just prices, right? Who cares about price? It's it's the fundamentals the only thing that matter." Or vice versa. You got other people say, "Hey, technicals are all that matter, and fundamentals are poo-poo," right? So it's the way I look at it is simply is that fundamentals matter. What you buy, what you pay for, the valuations you pay for things certainly matter in the long term, right? So, and think about this as if you're driving down a road, and I know for a fact as I'm driving down a road, I can look down the freeway and it can be perfectly straight. If you've ever been on I-10 going from Florida to California, it's perfectly straight in a lot of areas. I mean, you can just look for miles and nothing turns. But eventually there's going to be a turn in the road. So, fundamental investors, they look at that road and go, well, I know that road's going to turn up there, so I'm going to turn now. And so they go driving off the road into the ditch. A technical investor goes, look, I know the road's going to turn up there, but I'm going to watch the signs that point me that say, curve ahead, right? And I'm going to turn when I see the curve. And that's really the important thing about managing money is understanding that, look, long term, we know that things are going to happen. In the short term, things can defy the fundamental logic. We know that road's going to turn up there somewhere. We just don't know where it's going to turn. So for now, we just have to watch the signposts, which right now tell us the road is straight. So, keep driving ahead and it's fine. I mean, look, we bought Nvidia last Monday. Nvidia had a very nice correction after their earnings. And so we added a little bit of Nvidia to our portfolio. We owned it before, we sold it. Had made 100% gain on the stock. The stock kept running up. So we've been kind of waiting for an opportunity after earnings for the stock to pull back, give us a little entry point. The stock is stupid overvalued, right? It trades at 43 times sales. It is completely ridiculous, the valuation the stock trades at. But technically right now, that's where the market's hiding out, right? Everything's hiding in these top 10 liquid stocks. And we can talk about safety and liquidity, as a function of what's driving markets. But, so we have to own it because we need participation in our portfolio. We need our portfolio to participate with the markets. But we also have on the other side of that ledger, we have a bunch of other fundamental stuff out there that it's not performing now, but we know that eventually it's going to perform well. So we're willing to have that component in the portfolio, waiting for that to perform. But in the near term, we also have to create performance for our clients. And so that's why we own things that don't fundamentally make any sense, but technically they're doing fantastic right now.
Okay, yeah. So this is back to the old, you trade the markets you have, not the market sort of you wish you had or you think there should be. Just to build on your I-10 analogy there, you've got a straight road ahead of you. You're going through the West Texas scrub, right? Looks like the moon out there sometimes. Yeah. And maybe you've driven the road before, you're going to have to turn right at some point, right? Right. But right now the road is straight, so you're going straight. So it's like, even though the road's going to turn to the right at some point, you wait until you get to that crossroads to take the right. You just don't take a right on the straight part and start going through that moonscape, right?
Right. Yeah.
Yeah.
And look, and I think that's the biggest mistake that both investors and analysts and everybody else, makes. And look, I'm guilty of it too, right? I mean, if I could have had perfect prediction coming into this year, I would have sold everything in my portfolio and bought 10 stocks, right? That's not prudent. That's not smart. That's not being a good fiduciary for our clients to do something like that. But, looking at the data, that certainly would have suggested that was the right thing to do if I just wanted to try to beat the pants off the market. But, again, we have to pay attention to these other things and understand that, predictions are only good for so long, and we've talked about this before, is that people that are making prognostications saying, hey, in 2024 you need to be here because this is what's going to happen, or in 2025, that's pie in the sky. There is no way anybody can predict that far ahead with any accuracy at all. So, because things happen.
Hey,
and so your point,
Yoga Berra, right?
Yeah.
Predictions are hard, especially about the future, right?
Exactly. And it's funny, while we talk about this, let me see if I can find a chart. Keep talking, and I'll see if I can find this other chart. I'll show you. But
okay. Look, I mean, if we want to say, if we had perfect vision, I mean, you should have taken all your clients' money and walked into the casino yesterday and put it all on the roulette wheel number that was going to come up, right? But we don't live in that world, and you, especially as a fiduciary, and maybe we'll talk about that just for a quick second at some point here. You don't have the luxury of taking sort of wild ass guesses and running on a hunch with your client's capital. You actually you're held to a professional standard, right? That basically says, look, I have to follow these certain disciplines and be able to demonstrate that to a regulator that, hey, the decision I made here on this portfolio allocation was based in this data, given these probabilities. And you really need to be able to defend that to a rational arbiter that, hey, you were really taking, a measured and risk appropriate approach when making a decision, right? So in many ways, even if you wanted to do something wildly nuts because you had a strong gut feel, you really can't. And that's one of the benefits of working with a professional advisor is they are bound to that responsibility.
Well, and look, and that, that's, it's always a part of the view about what you consider being a fiduciary. I can make the case that I'm a fiduciary by putting you all into an S&P index fund because you'll never do worse than the market. You'll never do better than the market, but you'll never do worse than the market. So, and for me, that's not really being a fiduciary because you're not really providing any service, right?
Right. You could just tell that person to go into an index fund. You don't need to siphon off of that. Yeah.
Exactly. So, you've got to be careful with that fiduciary term because, again, technically under the SEC, if I just stick you into a bunch of index funds and then charge you a management fee for that, I'm being a fiduciary because I'm, giving you some advice and I'm not doing anything that's going to cost you a big chunk of capital. And the beautiful thing about that is that if the market's down 50% and you're down 50% in your portfolio, that's okay according to the SEC because you didn't do any worse than the markets. The risk comes in for an active manager like me is if the market's down 50 and you're down 60 because I made really bad investment decisions. Now I'm responsible because I would have done better for you just by sticking you into an index fund. So, you got to be real, that term for people throw that around a lot, but I think it's really important to focus on what does that actually mean,
right,
in terms of what am I doing with your money, and not just your money, but your overall service, your planning, everything else that goes into that whole financial service that you're providing, which is why at our shop, we spend so much time on the financial plan, long-term, those type of things to really make sure we're providing that fiduciary service to our clients.
Yeah, and just to help people understand, so let's say I'm in my late 70s, right? And you take my money and you put me all in half in GameStop and half in Shiba Inu.
Yeah, nothing wrong with it.
What would happen, in those crater, right? I mean, what would happen in that case? I mean, would you get a call from a regulator and basically, do they audit your books? And, what would happen if they were to say, you know what, that was a wildly inappropriate allocation for a fiduciary to make?
So in that situation, if that happened, so first thing we'd do is that the client, right, would go to a lawyer and they would say, hey, I'm suing my advisor because he put me in these wildly speculative investments. Even though I told him I really wanted these, he put me in them. And they lost a bunch of money. And I don't like the fact that I lost money when I thought I was going to make a bunch of money. So now I want to sue him. So he files a lawsuit with the lawyer against the firm. And then that's going to get picked up by the SEC when that occurs. So they're going to launch an investigation into what's this lawsuit about. And then that's going to wind up in front of an arbitration board, or it's going to wind up and generally these things wind up in settlement. So as soon as you get into a settlement, the client says, well, yes, I actually asked for those stocks, but they lost a bunch of money, so now I want my money back. So the insurance company will say, okay, pay them. And so now the advisor, regardless of whether he recommended these or not, are going to have a ding on his record for making this recommendation. The firm's going to get fined for making that. And if it was insidious across the whole firm, the firm stands a risk of also losing their ability to practice, and the advisor.
Okay, and that's where I'm going.
It can get very serious.
Yeah, and that's where I'm going. So let's separate two things, because I know you're saying it because it happens a lot, where the client actually asks to do something harebrained, right? But putting that aside for a second, if the authorities determine that the firm really acted against their fiduciary responsibility, you're saying that the consequences are actually pretty darn severe.
Right, there is. And the reason I brought up the client saying, because we get this all the time. And clients come in and say, oh, and look, I get emails from even, people that watch this channel that I, respond back and go, we're not an advisor for you. Because they're asking for things that are absolutely non-realistic. I want to quintuple my money in 5 years, right? So I want you to manage my portfolio. That's not realistic. And by accepting that type of view into our firm, it's, we're having to put what is fiduciarily correct for that person, out the window to try to generate this 5 times return over 5 years thing. And that's not being a good fiduciary. Our responsibility is to look at you and say, that's not a realistic goal. That's not good for you. And we won't do it. As a firm, we will not honor your wishes of buying you AMC and GameStop. We're not going to do that because it's not right for you. You'll need to go find another advisor.
Right. And so you're trying to do the right thing for the person, and you're honestly trying to protect your firm because you're held to these higher standards. Okay. Didn't want to rat hole on this, but really interesting. I got a number of things I want to get to, but real quick, I think you were searching for a chart. Did you find it? I
did. I found it. So here, let me share this here real quick. And the reason I bring this up is because, again, we were talking about predictions, right? And I've brought up this example in the past, and actually just recently the Daily Shot published this chart, and it was from about weather forecasting accuracy over time. And I brought up the fact that they used to do a survey of everybody that made predictions: meteorologists, psychologists, psychics, all this other stuff. And meteorologists were the most accurate for 3 days in advance. And I thought it was interesting because Daily Shot just published this chart on Thursday. And this is weather forecast accuracy based on air pressure. And they are nearly 100% accurate 3 days ahead. Once you get to 10 days, that accuracy falls to 50%. So they're only a coin toss 10 days into the future. And so I bring this up is the reason this is important is because you hear all these people on TV, the media, financial analysts, et cetera, going, oh, well, next year earnings are going to do this and the economy is going to be here. And because of X, Y is going to happen. And this is the result of this. It's some of that's based on data. A lot of it's based on historical past data. But if weather forecasting, which is based on real-time data, is only accurate 50% of the time, 10 days in the future, how when you're talking about 365 days in the future or 5 years in the future, how accurate do you think that really is? And particularly in an environment that is impacted by so many different variables, from economics to politics to geopolitics to monetary policy to fiscal policy, all those things can change from 1 month and 1 year to the next. It's going to completely change the outcome of whatever prediction is today. So my point is making any bet longer. This is why, right? I bought Nvidia. I can't believe he bought Nvidia. It's so overvalued. Even he says it's overvalued. He bought it. It's because it's going up, and I need to own those top 10 stocks right now because that's what's driving the bulk of the returns in the market this year. I know it's overvalued, but this is what the data is saying right now. And that prediction is going to be right for about 10 days to 30 days. But when that data changes, I'll sell it and I'll move on to something else. But this is why it's important when you start talking about very long-term outlooks on things. Oh, I'm convinced that the world's going to be like this in 5 years. Maybe. This is the whole problem with people talking about climate change. And 1980, we were talking about the world was going to be on fire by 2000, and we're still talking about this.
Right. Or underwater by 2020, but yeah.
Yeah. and Plymouth Rock is still in the same place it was in 1620. So, the water level is still the same. So the point is that, all these events can certainly take place, right? These things can certainly happen, but timing of those events and the actuality of how the event turns out can be very different things because of all these different impacts that occur over time. And things that will change. Will the Fed, cut rates? Will they start doing QE? What's that going to mean to markets? That's what we're going to be dealing with.
All right. Great point. Great reminder. I don't want to get into it yet, but I do want to get into it very soon. There's now a lot of, I would say, diverging opinions on what's going to happen with long treasuries. Right, just to show how you can have smart people look at the same environment and come to very different conclusions. Right, so we're going to dive into that. I see you kind of smirking there. But
I made charts for you.
Okay, good. But before we get there, two questions. One, just about Nvidia, because I'm sure some people are listening to are thinking this, which is, okay, I get Lance is making a taking a technically based position here with Nvidia. Hey, what happens if he's wrong? What happens if he's top ticking Nvidia right now? So what sort of defense do you have in place for that?
Well, so the stock had spiked up on earnings, right? And then sold off entirely on the day of earnings, came back down, had tested reasonable support. It's been in a consolidation range now for about 3 months, broke out of that consolidation range. Came back down and retested and held that consolidation range, which gave us the entry point we're looking for. It got oversold. It triggered a MACD buy signal, just like the market. And so it made a decent entry point. So if it takes out that stop level, we'll sell the position.
Okay. So basically you've got a stop level in place that, okay, great.
Yeah, but we never buy a position without having a stop on.
I imagine that, but I'm glad that you're specifying that for folks here, right? Yeah, and again,
and some people go.
I'm doing this instructively so that people realize and learn what a professional financial advisor does. He just doesn't take a willy-nilly long position, right? There's a lot of logic behind it.
Well, yeah, and look, and some people go, well, you're down on TLT this year, and you haven't been stopped out of it. Yeah, our stop level is actually a lot lower than where it is now because you got to break a whole bunch of economic trends to hit that stop level, and we're not there yet. So yeah, the position's down. But our thesis on long-term treasury still holds. And in fact, we are going to sell TLT. And we talked about this not last Friday because I wasn't here, but the Friday before. We are going to sell TLT, probably going to do it on Monday because rates have now gotten to kind of our ideal entry point that we've been looking for. So we're going to basically sell TLT and then buy an equivalent 20-year treasury bond and replace that ETF in all of our portfolios with an actual treasury bond and lock in that rate that we've been looking for that we think will probably be the top tick in rates here for quite some time.
Interesting. Okay. Again, I want to wait to really get to this conversation because there's one more I want to have before, but just to clarify for folks, because I think the other week you guys were still contemplating selling TLT, but because you were going to buy it, perhaps another ETF that was even further out the duration curve, but sounds like you've made the decision, nope, we're just going to buy the bonds themselves.
Yeah, and it really came down to a couple of different factors. One was, there's a couple of things that drive portfolio allocations and portfolio changes. One of those is sizing. We have portfolios that range kind of all across the gamut, and this is why when you talk to most financial advisors, they typically have a minimum asset size. Like, hey, we'd love for you to be a client, but you got to have at least $500,000 for us to do it. And it's not, there are a couple of business reasons for that. It's very hard to be financially efficient in terms of running a business with very small investment accounts. But it also comes down to position sizing. Sometimes if I'm trying to buy like a Chipotle Mexican grill, right, that stock, it trades about $1,690 a share last time I checked. So if I'm going to buy one share of that at $1,690 a share, and if you have a $10,000 account, all of a sudden I've got 16% in one stock. One share of one stock makes up 16% of the account. So that just doesn't make sense on an allocation basis. And that's why, typically you need larger amounts of dollars to do a proper allocation across, so many stocks and so many bonds. But anyway, long story short, we were working through all the math and we had long conversations with our broker dealers that we work with. And we were able to work out a position to where we could buy and sell very large blocks of an actual treasury bond, even in smaller accounts, that it made sense to, rather than buying another ETF, it's just swapping all of our ETFs for an actual bond.
Okay. All right. I'm sure we got people's attention with that. So, okay. We'll revisit that a little bit later on this conversation if need be. Before we get to the long bonds, I just want to talk about some more market news this week, which is jobs, right? Looks like we may be finally seeing some fracture lines that matter beginning to appear in the jobs market. So we had the jolts report recently, and that was disappointing, right? Jobs openings. So we're beginning to interviewed Stephanie Pomboy recently, and she said she has a whole report out there she titled the report Jaws, because we have so many data points where we have these like big divergences going on that create these alligator jaws that are now beginning to starting to close. So we're starting to see that disparity between job openings and job applicants begin to narrow. Hasn't closed yet, right? But that's something that's been persisting for a couple of years now. And it seems like the Fed is finally beginning to make progress towards starting to cool off the jobs market now. That's beginning to start to close. But I think more meaningfully was today's non-farms payroll report, right? Where actually the August number was a beat, right? And we've had to beat, pretty much almost every month this year. I mean, this year, almost every month has been a beat versus expectations. But then, they give the rosy new number, right? Oh, this was a beat. And then they go and, behind the scenes and they revise down the previous numbers, right? And Lance, it's gotten to the point now where they have now revised down every single month of payrolls for this year, for 2023, right? And let me just read this real quick. July was revised down by 30,000 jobs. June was revised even more by 80,000, which means that a number that was originally reported as 209,000 as a big rosy number has been revised 50% lower to 105,000, and a collapse versus the original expectations of 230. So, we're just seeing this sort of, false window painting, lipstick on a pig. Look how great the current month's numbers are. And then, of course, those numbers get revised as soon as the next month's numbers are out. What's really important about this is with these revisions, the unemployment rate is now beginning to move, right? And it had a pretty big jump month over month from 3.5% annually to now 3.8% annually. So we're beginning to see that number, which was, super rock steady for so long, begin to start to move higher. At the same time, wage growth is continuing to slow. Right? I think we're at like 4.3% year over year right now, but you can definitely see the trajectory is, beginning. The balloon is beginning to sink here. So we've got, more people not working now. Jobs numbers really beginning to look a lot weaker than they have in the past. The monkeying with the data, which you and I have said we thought's going on behind the scenes, definitely now we've got proof it really is going on. And the wage pressure, we had a little bit of a moment there where it looked like workers, might be beginning to get some bargaining power. Seems like that's sort of fast dissipating. So I mention all this because you and I have spent a lot of time talking about the importance of employment, where it's sort of, Michael Kantrowitz and his HOPE framework. That's been the last bulwark against entering into recession. We've been watching that closely because if that starts getting wobbly, that makes the likelihood of a recession more probable. How much has this data caught your attention?
I mean, and it's great for bonds, by the way, because this is, going back to our bond thesis, is that weaker economy is exactly kind of what you're looking for. But no, I mean, look,
sorry to interrupt that, but the stupid thing is it's good for stocks too, right? I mean, stocks have jumped on the news because, hey, bad news is good news, right?
And we actually had that discussion earlier this week on our podcast, which is, we're back to that bad news is good news thing. Why? Because bad news means that the Fed is unlikely to hike rates further from here. And so that also means that we're closer to rate cuts, which in theory, this is the mistake the market's making, is that in theory, rate cuts are great for stocks, right? More monetary liquidity, reversal of QT back to QE. That's what everybody's kind of hoping for. 12 years of stimulus was all great for stocks. What everybody forgets, though, is that initially when the Fed starts cutting rates, they're cutting rates because they're trying to stop something from breaking, or they're trying to fix something that's broken. And that's not going to be good for stocks at all. And you're going to see a big decline in the markets at that point. And again, this is, why we pay such close attention to the data. But, that's, look, the numbers are still positive, right? So first of all, let's not get the cart too far ahead of the horse. Yes, employment is slowing. It is certainly concerning that it's slowing. And a lot of the stuff that we've been talking about for a while is certainly starting to kind of show up in the cards, right? We're starting to see weaker growth, weaker job openings, those type of things, but it's not recessionary yet.
Yep,
so
it's still above water. It's just struggling.
It's struggling. But this is good stuff to pay attention to, saying, hey, look, there's certainly, going back to your Jaws analogy, there's fins in the water. Probably don't jump in the water. Right? So, probably means stay in the boat, but it doesn't mean you got to get out of the water, right? You stay in the boat and drive back into shore at your leisure. Just don't try to swim. But this is, look, all this stuff is kind of playing out, this lag effect that we've talked about, ad nauseum for months now. We're starting to see that begin to actually take root. And again, we talked about in 2022, everybody was expecting a recession. And we said, hey, everybody expects a recession. Bob Farrell says, if everybody expects something to happen, probably not going to happen. Now, nobody expects a recession. Earnings estimates are getting dragged higher. Economic analysts are ratcheting economic growth rates higher. And that's exactly kind of what you want to see, because now we have all the experts on one side of the boat again saying, oh, well, we're not going to have a recession, which actually in theory kind of sets us up to have the recession now. So maybe in 2024, we actually see kind of the early maturation of that recessionary environment.
All right. Yeah, as we've talked about, that is beginning to build the slope of hope, right? Yeah. That a bear market likes to go down. Yeah, you mentioned the lag effect, and man, I talk about it all the time. But it blows my mind how the market is totally ignoring it on both sides, right? Which is the lag effect of all the tightening and hiking that's been done, right? So, that's what's likely, what you and I think fundamentally is likely to kind of drag things down from here, right? And that's the gravitational effect of that is likely going to get stronger the further we go in the timeline here, as the lag effect fully expresses at full magnitude. But also, if and when the Fed pivots, I mean, the Fed will pivot at some point in time, there's a lag effect to stimulus, right? It takes quarters for that stuff to start getting expressed in the economy, which is why, as we've talked about a lot, when we enter into a recessionary period where the Fed starts cutting, going into it, like, oh, okay, we see the recession now, it's time to start cutting. The markets usually go down for several quarters, right? But the market's ignoring both of those.
Well, and again, again, let's go back to the highway analogy, right? The market is aware of this stuff, and again, as we talked about before, the stuff that we talk about now is already getting priced into the market.
You and I don't have any data that the full market has. Yeah, we get it. Yeah.
Yeah. Well, but everybody's talking about stuff, right? So everybody's talking about whatever you want to, China or Europe or whatever it is, housing, whatever the issue du jour is that everybody's stressing over. The market's already pricing that in, right? And so here we are, we're on the freeway and it's perfectly straight right now, and that's what the markets see. And so the markets are just basically playing what the environment is that's directly ahead of them. And remember, I'm writing an article on this for Tuesday after next, talking about portfolio managers. The reason that the top 10 stocks continue to perform the way they're performing is because everybody's piling into those top 10 stocks because they're safe. They have tremendous amounts of cash on the books. Think about how much cash Apple, Microsoft, Google have on the books, like billions, hundreds of billions of dollars just between them. You take a look, we talk a lot about money market fund balances, and it's like, oh, everybody's piling into money markets. That's not retail. Retail is a very small chunk of money market fund balances. It's mostly pensions, major corporations, hedge funds, mutual funds, et cetera, that have billions of dollars in cash in the money markets. That's where most of that money market pile is coming from. And these companies like Apple, Microsoft, Berkshire Hathaway, Warren Buffett, they have nothing to do with cash right now that's worthwhile. So they're just shoving it into 5% money market. Why wouldn't I? Right? I mean, I'm getting a great return on my cash. Why not just stick it there? So for investment managers, they're going, okay, I need a place where I can stick money that it's easy in, easy out. I can put $10 billion to work in Apple today, and I won't move the price of the stock. And I can yank it out tomorrow and it won't move the price of the stock because so much money trades in Apple every single day. You try to do that with a small cap company, you're going to send the stock price either rushing off to the moon or crashing, one of the two. You just can't move that much money in and out of the stocks. There's no liquidity. So when I'm in an environment where I've got to have money, look, I got to have money invested. We've talked about career risk before. If I'm not performing with the market, I'm going to suffer.
You're going to lose clients, yeah.
Yeah, I'm either going to lose clients or my job, depending on how bad the performance was. So career risk is a very real thing. So as a portfolio manager, I've got to have exposure to the markets. The markets are going up. I keep piling into those top 10 stocks because easy in, easy out. Furthermore, if you take a look at interest coverage, and I put some charts out on this on Twitter last week. I'm actually covering this in this weekend's newsletter on the website, realinvestmentadvice.com. So if you haven't subscribed, you should subscribe there.
You should, everybody. Go to realinvestmentadvice.com. Absolutely.
So, but this weekend's newsletter covers this. Andrew Lapthorne over at Societe Generale, and I have a good buddy of mine, Albert Edwards at Societe Generale. We put out some fantastic research. But Andrew Lapthorne did some really interesting coverage. One of the things that's been kind of a phenomenon over the last couple of years is that interest service of companies is actually declining, even though interest rates have been going up. And so it's kind of a head scratcher. And what it turns out, we
talked about this, but a lot of people have forgotten. So this is really interesting.
Yeah. So the head scratcher about that is how can that be? If interest rates are going up, then interest coverage, interest service should be going up, not down. Well, it was because all these big major companies, Apple, Microsoft, Google, they went and financed at zero rates. They were out, Apple was borrowing billions of dollars to do share buybacks at virtually zero interest rates. And so now they don't have any debt maturities, and there's no reason for, even though interest rates are going up, their interest service is basically coming down because they don't have any refinancing. However, once you drop out of that large cap and go to mid cap and small cap, there's real problems there.
Right.
And they have a tremendous amount of term loans coming due in 2024 and 2025, and they don't have the interest service coverage to cover that. So now back to why I'm hiding in mega cap stocks. If I buy small and mid cap, and by the way, if you haven't looked at the mid cap index, it's gone nowhere since October. The S&P large cap index, the NASDAQ large cap index, they're up 15, 30%, for the year. Mid cap, small cap, nowhere, just flat line, because nobody wants to be there because that's where the risk is. And if they can't cover their interest service, and if they come up on a refinancing in 2024, 2025, and they can't refinance, you're going to see bankruptcies really start to rise. Bankruptcies are up 71% year over year. Now that sounds like a lot, but when, it's math. But if you had zero bankruptcies last year and one bankruptcy this year, that's 100% increase, right? So it sounds like a lot. It's like, wow, they're up 71%. The world's coming to it. No, you had virtually no bankruptcies a couple of years ago. Now you've got a few, but that is going to start to accelerate in that small and mid cap space if interest rates don't come down soon before they have to refinance, or if they have to refinance and cannot get financed, then you're going to have a real problem on that. So that's why there's no money flowing into the small and mid cap stocks, and that's why they're underperforming. And that's why money's just piling into large caps. It's safety and it's liquidity.
All right. We are not going to make it through my list because I got to ask a question around this. So, market, and you made a great explanation for why this is happening, but many market participants are kind of seeking the safety, hiding out in these large cap stocks, and, in this year, getting appreciation, right? Those stocks have been performing well, right? It's that old saying, like, trees don't grow to the moon, right? Like, how long can this persist for, where these top 10 companies really become more and more and more of the market, right? And of the economy, right? And kind of around that, like what will it take to, if they begin to hit limits, what will it take? Will it actually have to take a recession? Will these companies just have to start making less for this trend to begin to break up?
Well, remember, it's always always about earnings and earnings expectations. Right now, these stocks are going up because expectations for earnings growth is fairly strong going forward. You know, look, let's take Nvidia as kind of the darling of everything right now. AI, it's going to rule the world. And so, you know, it was interesting in their last earnings report. So go back 2 quarters, they had an earnings report. And they said, we expect our sales to grow by 50% over the next quarter. Okay, so 50% growth. They nailed that, but they did that well. Because they already had orders coming in from Elon Musk.
Right, they could see it, yeah.
So they knew what was coming in. So he said, our sales growth will be up 50% over the next quarter. Okay, Adam, you're pretty good at math. What's 50% times 4? 200, right? So 200%. Yep. So if I annualize 50% sales growth over the next 4 quarters, that's 200% sales growth. Wow. I certainly want to own a company that's growing their sales at 200%. So stock runs up. When they announced in the latest quarter, they said, we estimate our sales growth annualized to be 170%. That's actually a slower rate of sales growth than what they reported the previous quarter. So it's still strong. I mean, you cannot deny 170% sales growth, but it is getting weaker. So at some point, if the economy slows down and all of a sudden these, you know, this piling into AI as an example, and everybody building out data centers and all that, there's going to be a point of maturation where you get to kind of peak AI, right? And we've seen this with the dot-com bubble and everything else. There's not, to your point, trees don't go to the sky. There will be an end to this. And so what is going to drive money out of these big mega cap stocks? So two things. First of all, we've got to reach the point to where people start to question the earnings, right? Or actually earnings decline. You know, Apple comes out and says, hey, you know, we only sold 40% of what we thought we'd sell in iPhones, you know, last quarter. And Nvidia comes out and says, well, we screwed the pooch. We only sold half of what we thought we were going to sell. A big order fell through for whatever reason. That's going to cause those stocks to come down rather sharply because, again, I've got to start repricing those valuations, right? The stock price versus what I'm actually paying for. That's got to get repriced. So that's going to cause money to flow out of those assets. But here's the other problem. Where's it going to flow to? Right. Money can't. And so, you know, money's like energy. You can't destroy energy. It just, you change its form, but energy is always energy. So money's got to go somewhere. And so if money's coming out of the top 10 stocks and you're in the middle of a recession, because if Apple, let's be honest, if Apple ain't cutting it, nobody else is either, most likely. So where's money going to go to? Well, if your thesis is that in a recession that interest rates are going to be taken off to the moon, then it can't go to bonds. So money's got to go somewhere, and it's not going to go to cash. So again, because money, you're not going to pay a mutual fund or a hedge fund to be in cash, right? So they've got to invest that money somewhere. So you've got to make the premise, and I'm not denying the fact that ultimately this rotation will occur. But when this rotation occurs, and while it will be during a recession, you've also got to understand where will money flow to and be early to that bet.
All right. Well, that's a good segue then to the next topic here, right? Which is Treasuries. Okay. Right? In that type of environment, I would think that a good chunk of that money, you know, recession, trouble in the big darlings, money's going to be freaked out. It's going to seek safety, right? So that's an argument for going into the US Treasury bonds. As I said back earlier in this video, you know, we've had a number of people on this channel of late. I would say you're probably at the front of that crowd, you know, waving the flag, saying, hey, we think this is a really good time to be looking at long duration treasuries, right? You gave a nod earlier to some of the decisions you're making, you know, in real time around this. We had Luke Gromen on this channel earlier this week, who really had a very different thesis. And I love that because it's a thoughtful thesis. You may disagree, and you know that's what makes a market, right? Is when intelligent people come up with different opinions. I don't know if you had a chance yet to look at that segment at all, but if so, you know, how would you react to Luke's argument, which was sort of heavily based in the price of oil, right? Where, you know, he basically says, look, you know, oil is going, we've sort of seen peak cheap oil. He expects oil prices to go higher from here. Oil will almost sort of be the new Fed funds rate, right? It'll be the limiter on the economy, but it's one that the Fed really can't control. And in fact, he thinks that if we get into a, you know, rough patch economically, and the Fed stimulates, that's going to goose the economy, which will then increase demand for scarce oil, shooting oil prices even higher, having that act as an even greater brake. So, so his outlook is based in that. What's your general reaction to him?
So, I never disparage anybody. So to your point, his views are just as valid as my views versus anybody else, because, well, as I said earlier, unless we're predicting what's going to happen in the next 10 days with the weather, nobody has any idea. But, I think there's a few things that we have to think about, right? So, first of all, let's go under the assumption that, oil prices are going to rise dramatically, right? Let's just throw out a number. Let's say $300 a barrel. Okay. So let me ask you a few questions. And
which would be Armageddon.
Well, yeah, but let me just ask you a few questions. Okay. So if oil prices go to $300 a barrel, what happens to economic activity?
Yeah. Grinds to a halt.
Right. If economic activity grinds to a halt, then what are oil producers going to do if they're not selling oil?
Well, they're certainly going to stop drilling for it. They're going to stop producing it.
Right. And so you're going to have a cut in production. So if oil prices are high, but they're not shooting off to the moon, right? And if oil prices are rising in kind of a normal fashion, and the price of oil is at a good level, what are oil producers going to do? They're going to produce more, right?
Right.
So one of the theses that Luke brought up, and I thought was interesting, because he talked about shale production, which has been declining as of late, and that's a true statement. It's interesting that post the kind of economic shutdown, we did have a recovery in the number of drilling rigs out there, but drilling rigs didn't actually retrace back to the number of drilling rigs, didn't retrace back to previous peaks where you thought they would be. But a lot of this has to do with the current administration, which is, restricted a lot of drillings, won't give permits. The permits they do give are in areas that they don't want to drill in, a whole variety of issues.
Right. Yeah, a lot of uncertainty as to whether the oil companies will get back their investment, and also higher interest rates. Since higher interest rates have gone up, it's more expensive to drill, and a lot of the guys only were getting along because of the cheap money. Yeah.
And also don't forget higher labor costs, right? So wages have risen, all this, right? So a lot of reasons why economically we haven't seen the number of wells come up. So, the point though is, if you have high oil prices, ultimately you're going to have more production. If you have more production, then demand is going to, you have a supply demand balance that's going to keep oil prices capped at some level, right? So it's always about production supply. And I just wrote an article, Friday's article on our website, is about Jerome Powell last week. And I'm a quick deviation, but I'm going to come back to Luke's point, because I actually touch on this a little bit in that article. But it's talking about Jerome Powell, who was very disingenuous and really went out of his way to obfuscate the cause of inflation. He blamed the Russia-Ukraine war. And he said, this Russia-Ukraine war created the supply-demand imbalances, this created inflation. And that's as much as I can ever hear from any one person in one speech, because it is simply a function of economics 101. You have too little demand because the government literally shut down the economy and sent everybody home and said, do not come to work. So you shut down the economy. So you have this contraction in supply. And then you send those same people that you sent home from work and said, don't work, I'm going to send you $5 trillion in cash to go spend. So you have this massive surge in demand against the backdrop of man-made created supply contraction. And so you had inflation. And as Milton Friedman once said, inflation is always and everywhere a monetary phenomenon. So blaming the Russia-Ukraine war was very disingenuous by Powell, but I get it, right? He's got to protect himself. He's got to protect the administration. So he can't lay the blame at the feet of the people that it responds to, which is the government, for doing the monetary policy, and his own feet for doing the fiscal policy. So, I get it, right? We got to obfuscate the truth. But again, when we take, and specifically in that article, I go through some of the impact. So if you're going to blame the war, right, you have to. So what does Russia and Ukraine provide to the world? They provide what? Primarily
a lot of oil.
And what comes out of Ukraine? Wheat, right?
Food. Yeah.
Right.
Oil.
So wheat and food. What are the two things that we exclude when we calculate inflation?
Yeah, I know. Energy and food.
So if you're looking at core inflation, which is what the Fed looks at, mind you, and you strip out food and energy, that whole argument goes right out the window because we're talking about core inflation. We're talking about everything else that's in the economy. Okay, but here, let me share with you a few charts here. I even did a little PowerPoint presentation. I'm joking, but
All right, good. I appreciate that. And while he's pulling this up, folks, yeah, I had a lot of people email me after Luke's interview saying, hey, can you really make sure to dig in with Lance to get his thoughts, on the other side of Luke's argument. So Lance, being the star pupil he is, put together this PowerPoint presentation.
Yeah. So hold on, let me see if I can get it to actually cooperate with me. Okay. So this is a long-term history of oil prices going back to 1946. That's as far back as I can actually get oil prices. And look, through time, we've had a ton of reasons why we've had surging oil prices for one reason or the other. The Iranian Revolution back in the late 70s, going to the early 80s, we had this big spike in oil prices. Of course, interest rates went up at that time. Very different environment. We had no deficit. Debt to household income was extremely low. Debt in the overall economy was very nascent. Corporate debt was very low. So, higher interest rates at that point against a backdrop of very strong economic growth rates running at 8 and 9%, very high savings rates back then. High interest rates were not really a problem. But that was a function, and then we'll have some comparisons here with interest rates in a second, so just bear with me. But, we did have that big spike in oil prices, and then oil prices go nowhere for about 20 years. And this is the hard part for people to understand is that this is 2023. And we're worrying about oil prices at $80 or $100, $120. Everybody forgets that in the turn of the century, in 2000, oil was $20 a barrel. So yep. all this stuff that's happened since the turn of the century, and really the phenomenon of higher oil prices has been a function of really post-financial crisis events. What has all been in common with that era of our financial situation? And that's been the Fed injecting literally,
I would say, low interest rates, record low interest rates, right?
Record low interest rates and quantitative easing. There's a very high correlation between inflows and outflows of quantitative easing. In other words, you have a QE program, you don't. You have a QE program, you don't. And oil prices. Because again, there's a very direct correlation between the amount of drilling that happens when you have monetary impacts into the economy from the Federal Reserve, and then ultimately what happens with oil prices. But let's go back to 2008.
Hey, sorry to interrupt, but I want to build off that observation for 1 second. So there are two things that a lot of people in the macro world point to as just sort of sea changes that then influence, markets, economies, world events. One is Nixon slamming the gold window shut in 1971, and you can kind of see that here on the chart. Well, very soon after that, oil prices really started rising, right? And then there's the era of QE, right, which is correspondent there with the jump from average $30 oil to now average $80 oil, right?
Yeah, and the gold window, certainly is a viable argument, but it kind of loses a lot of its metric considering that oil prices were at $20 a barrel for 30 years. So again, the whole gold oil relationship kind of falls out of bed in the 80s and the 90s. Monetary policy holds a lot better correlation recently in the last 10, 15 years, but we can debate that till the cows come home. But I think the most important one is that spike in 2008 where we have peak oil. A lot of people probably don't remember the fact that everybody's running around with their hair on fire talking about peak oil. We're running out of oil. We're not producing enough oil. There's simply not enough oil on the planet to meet our demands, and the world's going to end because of this. And then all of a sudden we had this miraculous invention called shale oil drilling, and then all of a sudden we had more supply than we knew what to deal with. And so we go through these phases of, we're running out of oil. We don't have enough oil. Now we've got too much oil. And that's just a function of how economies work over time. If there is a deficit of anything, somebody's going to step in and fill that gap. Somebody's going to step in and fill the void that exists. That's how capitalism works. And that's why capitalism works over time. And it creates massive wealth within countries. But importantly, just like AI right now, there's a deficit of GPUs in the AI space. If you're building out cloud data centers and all that, there's simply one guy to go to right now, and that's Nvidia. And they kind of cornered the market, and they've got a big moat. But eventually, that deficit, we talked about this before, is going to drag in more and more competitors. There's going to be a new company you have never heard of that's going to show up in the next couple of years. That's going to make the best GPU on the planet. And everybody's going to shift to them because it's going to be a better GPU at a cheaper price. Who's going to make it? I have no idea. The company probably doesn't even exist yet, but that's what's going to happen. Somebody's going to come up with something better than a GPU. So just like we had, traditional oil drilling back in 2006, 2007, we're running out of oil, simply not enough oil out there. And then some Yahoo in Texas sits there and goes, you know what? I bet I could get some oil out of the cracks in the ground. And they come up with shale drilling. And, we have a whole new economic environment for producing oil and gas. But here's the important part about this. Let's keep moving on. So this is oil. This is the history of oil prices going back. You can see the spike in the Russia-Ukraine war, obviously concerns. And I remember also very quick, this very important part as we talk about all this, oil prices are not set by supply and demand. Oil prices are set by Wall Street and the NYMEX. These are oil commodity futures traders betting on the price of oil over a set period of time with futures, and that's what drives the actual price of oil that's traded on a daily basis. So again, this is very important to remember. This is a function of finance of what happens on Wall Street. Okay, so this is oil prices relating to kind of the economic situation. So we have backwardation that occurs in oil prices, and then when that backwardation corrects itself, you then typically, when you have that backwardation, you are in a problem of some sort, like a financial crisis, a manufacturing recession, the Brexit taper tantrum issue, the trade war, with President Trump. When you get these backwardations, then you have this unwinding, and that leads to this collapse in oil prices that occurs on a regular basis.
All right, sorry, can you explain for folks what backwardation is?
So yeah, that's a good question, Adam. So backwardation is when the current price or the spot price. So again, we were just talking about a second ago that really the price of oil is driven by the futures market and what's happening on Wall Street more than anything else. But it's when the current price or what we call the spot price of crude, in this case, that's the underlying, and you can have backwardation in any asset, but in this particular case, oil is higher than the prices that are trading in the futures market. And that can occur from time to time, again, because how does that happen is because you have speculators on both sides. Some people are betting it's going to go higher, some people it's going to go lower. And then there's the actual price that oil is trading in the open market. So it's just, again, it's a function of what happens, with this, movement in oil prices over time and people speculating on what the outcomes are going to be. So when you get these backwardations that occur, those eventually, and you're talking about the jaws between economic data. It's like, you have GDP and GDI, which there's a big gap between those two, and that shouldn't exist. So when you get these backwardations, those prices eventually have to correct themselves, and that's why after every one of these backwardations, you basically have a collapse in oil prices.
All right, and just to help folks think about it, the way I think about it is almost like with the inverted yield curve, where people are saying, you're willing to pay more for short-term certainty because you're nervous about what's going to happen in the long run. This generally is where people are freaking out that, okay, oh my gosh, supply is getting low and prices are going higher. I need to get my hands on it right now. So they're willing to pay a lot to get it now. And eventually that panic ends, right? And then the price corrects downwards.
Right. So again, so this is what's going on with oil prices. Now, again, to now back to the more important part, right? The interest rate, inflation, environment, and then what drives ultimately bond prices. So, if we look at, GDP as a function of what happens, whenever you have, and so the blue line is a 3-year average GDP growth, and then the black line is oil prices. And what you'll notice is that when you have these big spike in oil prices, you also have a growth in economic growth rates. And again, so back in the 70s, everybody wants to go back and revisit that period. It's like, oh my gosh, remember in the 70s when we had, spiking interest rates and spiking oil prices, it was terrible. We had back-to-back recessions, and we did. But again, oil, back then, 3-year average growth rate of GDP was near 12%. So very different environment than where we're growing today at, on average, since 2000, we've been growing close to 2%. Now, this is nominal GDP, not real. So this is 3-year nominal GDP. We were growing on average at about 3-4%, from 2000. We've had this spike up recently to about 8% because of all that money we injected into the economy. So that's why we got inflation, right? You had this big surge in economic growth because you had all this activity of shutting down the economy, this demand that then required this big, massive increase in activity to meet that demand. So you had this big surge in economic growth, but that's unsustainable because you don't have the monetary inputs anymore. That liquidity slowly coming out of the system. But that's also why when you had that big surge in economic growth, you subsequently had the big surge in oil prices as well, because you had more demand for oil coming in than what the supply would be. So as that normalizes and as GDP slows, oil prices will slow as well. And again, you see this back in 2008. We had peak oil. GDP was going higher, and then as soon as we popped the market, we had a big decline in GDP because of the financial crisis, and oil prices crashed right along with it. Exactly what you expect. It's all about supply and demand ultimately, and imbalances that occur. Deficits also matter. When you have big surging deficits, you're going to have oil prices moving. So again, whenever we've had big deficits, we've seen spikes in oil. That causes some type of economic event, and then we have to do more deficit spending to try to bail everything out, and that's when oil prices are collapsing. And then we slowly get back on our feet. Oil prices rise. We have the next event. We have to go into more deficit spending, and it's just a cycle we keep repeating. And we've recently had this big surge in spending with the Inflation Reduction Act, and we saw that spike in oil prices again. So this is just this kind of cycle we repeat with over time. And this is with inflation. Again, a very high correlation with oil prices and inflation. Inflation's coming down, oil prices are falling along with it. So yes, to Luke's point, if we do get higher oil prices, inflation's going to tick up. But again, that's not the measure that we really look at in inflation, because we talk about core, which is X food and energy. And if we take a look at this relative to interest rates, we can see that even during these periods where we had spiking peak oil, yes, interest rates ticked up somewhat. In 2006, 2007, interest rates were rising. And then when oil prices collapsed, so long did interest rates as well. And that's kind of been this consequence. And we had the trade war back in 2017, 2018 under the Trump administration. Interest rates were ticking up. The Fed went to their taper tantrum. We're nowhere near the neutral rate. And then when everything kind of wheels came off the cart economically, oil prices collapsed. So again, we're going to see the same issue here. When we hit a recession, interest rates are going to fall, oil prices are going to decline because of lack of demand, and you wind up in the same boat. I mean, the recession is going to be the thing that cures all of these inflationary evils.
Okay. So what I hear you saying from all this data is, all right, if you're taking the Gromen approach, you're saying, hey, there's actually lots of reasons to expect, at least in this part of the cycle, for oil prices to be coming down, right? As GDP mean reverts downwards, as inflation disinflates, et cetera, right? Yeah. And so if you're going to make a bond yields tied to oil prices argument, well, oil prices, from your outlook here, more likely to moderate going forward from here, at least in the nearest term. And that's going to bring bond yields down, down with it, raising bond prices, right? So you're nodding. Am I getting your argument here? I just want to say that Luke, I think, was making more of a secular commentary about bond yields. While he did say, I'm not going to buy them right now, he also did say, hey, these guys might be right in the short term. Right. And I kind of think that maybe it's almost sort of semantics, where I think you and your partner, Mike Leibowitz, are saying, hey, yeah, we think in the relatively near term, next 6 months, 2 years, we don't know exactly what's going to happen. Those moderating effects are going to happen that you mentioned, but probably something's going to break, and the Fed's going to have to step in with easing and pivoting and all that stuff. And that's going to be the opportunity to ride the long bond. I don't necessarily hear you saying, oh, we're buying these, we're selling TLT to get into longer term bonds themselves, and then we're going to hold them for the next 20 years. Right? To me, I feel like you're going to hold them until you get this price reversal that you're looking for, and then you'll probably sell them and put that capital somewhere else.
Well, yeah, but think about this. So again, let's go back to our thesis earlier. So, if you're expecting a recession and a crash in the market, then money's got to go from equities to somewhere, right? So money can't evaporate. So it's got to move somewhere. So it's going to move to the safety of treasuries, and that's going to be the case. And now, if that's occurring, then yields are going to come back down towards zero, like they did during the pandemic. The price of bonds are going to reach maximum price level. And again, unlike a stock, bonds cannot go up in price forever. So a stock can in theory, the price on a stock can go up forever, right? And there's no limit to how far a price of a stock can go, as long as people are willing to pay up for it. With a bond, though, there's an absolute price peak because interest rates get to zero. So, they cannot be priced into infinity because of interest rates eventually stop going down at zero. So that's going to be the issue. So when we get down to those very low yields, when we get down to very high bond prices and very low yields, there's going to be no reason. So if I own a 20-year bond, as an example, and at 10 years to maturity, the price of the bond, the price of the bond is maximized, the yield is near zero. There's no sense in holding that bond for the other 10 years because I will maximize my gain for that 20-year period in 10 years. So yeah, you sell the bond. And at that point, stocks are going to be, out with the bathwater at that point, where all my opportunity to buy cheap value stocks, et cetera, are going to exist. So yeah, I'm going to sell all those bonds. I'm going to go 100% long equities at that point and probably leverage at that point because the opportunity is going to be it'll be the crisis moment of 2008 where, you've got nothing but upside in equity prices. So, and I'm just waiting for everybody to be, convinced that when we're on the show, everybody's like, oh, stocks are going to zero. When you tell me that,
don't ever touch a stock again. Yeah.
I'm going to buy everything I can buy with both feet in my neighbor's hands. So, this is going to be that way. But yeah, it's just a function. Even if we look back, so to the premise that oil prices are going to drive yields higher, it never happened. In 2008, you had oil prices surging to the moon. The belief is that peak oil was here, and oil prices were going to $300 a barrel, and interest rates moved up a little bit, but they didn't go shooting off to the moon, right? Because there's a limit of where interest rates can function within the economy, and interest rates are a reflection of economic growth, wages, and inflation. So in the latest economic report, what happened to wages?
They're softening.
They're softening. What is happening right now with inflation? Is it strengthening or softening?
Well, it depends. The trend is softening. It bounced up last month, but yes, I know what you're saying.
Okay, 9-3. Okay, it's weakening. So, and economic growth is slowing down, right? I mean, from where we were back in 2020.
Right. I mean, not if you look at GDP now for the current quarter, but you and I know that that's probably not going to persist.
Well, it's also remember that's nominal and it's annualized. But if we look at the trend of economic growth, it is slowing from that 32% quarter that we had back in 2020, right? So you look at the trend of economic growth. So if economic growth is slowing, if inflation is declining, and wages are slowing, interest rates cannot go up.
Okay. All right, good. I think we put a really nice bow on this. Thank you for actually doing all the pre-work for this. So, folks clearly know where you are. You are still playing for this opportunity, which I'm going to call a near-term opportunity with a generous definition of what near is, right? Could be a quarter, could be a year and a half. We don't know, right?
I want to be clear. I want to be really clear about this because I don't want anybody coming back on you or me. When I talked about this 2 weeks ago, I said I remember I wrote the article. I said why I doubled my bond position. My outlook is 18 to 36 months. So if you want to call that near term, it's fine. But my term for this trade is 18 to 36 months.
Okay, great. So year and a half to 3 years, right?
Yeah.
Okay, and you're waiting to play for this opportunity that we talked about, right? All the reasons. Yields will come down, price will go up. At some point, you'll say, okay, I've gotten everything I can get out of this trade. There's now way better valuations appearing in other assets. I'm going to rotate out of that into those. Last question, just because I'm curious. If, I think Luke is making a case for secularly higher interest rates. he didn't say this, but I'll say it, you know, for the next decade or two, relative to where interest rates have been for the past decade or two. Do you have an opinion on that?
Yeah. So again, let's go back to what drives interest rates: economic growth, wages, and inflation. So look, so the argument is if you want to have secularly higher economic growth, so instead of growing at 2% as we've been doing since the turn of the century, we're now going to grow at 3%. Okay. So at 3% economic growth, interest rates should be somewhere between 3 and 4%. That should be where that is. If economic growth is now 4%, then we should be somewhere between 3 and 5%, somewhere in there. Interest rates are going to be fairly close, within a percentage point over or below the current economic growth rate in the economy. So you've got to make, so now go back to the issue. What is going to be the driver for higher rates of economic growth in the future and the ability to sustain that rate of growth with higher interest rates when you have a 5-to-1 leverage ratio in the economy?
Right. So I don't think that we're going to have higher average GDP growth going forward than we've had. But I guess maybe a counter argument is we had interest rates at sort of artificially low levels for the past couple of decades, right? There was a lot of intervention to keep them low. Are we going to be able to have that going forward, especially with debt levels as high as they are, where the world is just sort of waking up to the fact that, there's just sort of more risk baked into the cake, and the Fed can't intervene with impunity as much as it did because it's going to create things like inflation?
Well, again, we had no inflation for 12 years because the Fed was doing quantitative easing, one bout after another and keeping rates artificially suppressed. And we had no inflation from 2009 to 2020. The only reason we have inflation now, and this is the one thing that everybody keeps mistaking, is the only reason that we have inflation today is because you shut down the economy and gave $5 trillion worth of money to households to spend.
Yeah, it's the fiscal, because that goes straight into the veins. Yeah,
that's it. If the government would have just done nothing, right? Let the economy do what it's going to do. Look, and we have the flu every year. We've had pandemics in the past. When we had the Spanish flu, we didn't even shut down the economy. If the economy would have been left alone, yes, we would have gone through this whole pandemic issue. We could have worn masks. We could have done vaccines. We could have all this. There was really no reason to shut down the economy. But assuming we didn't, the economy would have slowed down. Inflation would have come down some. Interest rates would have come down some at that point because it had a recession. We would have gone through it. We would have been back on a normal track. And we still wouldn't have had the level of inflation that we saw because you shut down the economy and put in $5 trillion worth of debt. Maybe inflation would have been 4%. Maybe it would have been 5% at most, but I doubt it would have even been that because the economy was not growing that strong back then. Again, we've been running a 2.2% growth rate in the century. There was nothing to change that dynamic. And so except for the shutdown of the economy and $5 trillion in checks. So if we just get back to normalcy, right, and the Fed is doing nothing, we're going to be growing at somewhere below between 2% and 1.8%. Even the Fed's own long-term projections for economic growth is 1.8% now. And with the debt problem that we currently have, it's probably going to be somewhere closer to 1.5%. That's just a function of debt on economic growth.
Right.
You just, you can't just magically create economic activity. When you have high interest rates, it's already curtailing the spending of consumers. They're already being impacted by higher interest rates. So trying to, and look what's happening with mortgages on homes. Can you imagine trying to maintain a 7, 8, or 9% mortgage rate in an economy and trying to sell houses at the same time? That's one of your bigger inputs into the economy, and it's just not going to be sustainable.
Okay. All right. There's more to dig into there, but we got to leave that for a different day.
That's a whole show.
Yeah, that is a whole show. All right. So there is a piece you wrote where I'm just going to tell folks to go read it. It's germane to what we're talking about here. But you wrote a piece called "The Deficit Surge Will Lead to Lower Rates, Not Higher Rates Going Forward." I think it's really important for folks to understand that. We don't have time to dig into it today here because I got to land the plane and we got a few other things we got to mention first. So let me just jump to remind everybody that, Lance, one of the shoes that I think you think when it drops, which it is about to, could actually be really meaningful in the story of how perhaps we get from here to a potential recession, which is student loan repayments resuming. And here, as of the first day of September, student loans are officially now accruing interest again. And those interest payments will have to start, and servicing payments will have to start 30 days from now, at the beginning of October, right?
Can I say something really quick?
Oh, absolutely.
I got a great email. So my son has a Sallie Mae loan for his college. And I got an email from them because I had to co-sign for his loan. And they sent me an email and said, just a reminder, Sallie Mae is not a federal student loan. So anybody that has told you there's been any sort of forgiveness or any reduction in the payment that you owe is incorrect. Your loan is accruing interest. Your first payment is due on the first day of October because we are not part of the federal loan. We are a private loan committee through, Sallie Mae. So it was, and my point is I thought it was interesting. Immediately they sent an email saying hey,
you're on the hook, buddy.
Yeah, you have to pay this loan. And so don't think you're getting off on anything. So, and there's a lot of these, private loans that are out there that, were put together that people owe money on, and they're, going, oh, well, I don't have to make a payment on it because it's a federal loan. It's not. You owe the money on it.
Well, so I chuckle there just because these GSEs, these government, sponsored entities, they just love to have their cake and eat it too, right? When they want to be bailed out, oh, we're a public entity, you got to bail us out, right?
And when they want their money, I'm private, send me money.
Exactly. Exactly.
Yeah. So,
all right. So anyways, I just want to let folks know that we've been talking about this. It's been academic for just quarters and quarters of discussion on this channel. It's now beginning to become actual. All right. And I can't remember. I actually don't think we talked about it last week because we had the end of life presentation. But there was a survey that came out last week that CNBC reported, and I'm going to forget the numbers exactly, but there was some large percentage, north of 50%, of survey respondents who said, I'm actually going to be like deciding between, food and making this payment, right? I'm probably going to be at least reducing the food I buy. It's going to be cutting that deep into my essential spending. Go ahead.
That's a very critical point. And I think it's something that has been overlooked by the media. Look, I've written about this already. You're talking about a $12 to $15 billion hit on a month. The thing about student loans is they are not dischargeable through bankruptcy.
Right. So
when you're having to make that decision about what do I pay and don't pay, you don't get out of it by filing bankruptcy. So if I think I'm gonna wind up having to file bankruptcy at some point, I'm not going to pay my credit card. I'm not going to, pay other debtors because I've got bankruptcy protection on those things. I'm going to pay the student loan because I don't have bankruptcy protection on that. So I think we might see some of this spread. Yes, to your point, see a reduction on maybe eating out as much. We've seen a lot of millennial spendings on, entertainment and experiences versus durables. We'll see a cut there, but we could also see those bankruptcies and credit card delinquencies really starting to pick up.
Yeah, well, that's a great point, right? Which is, what debt do you default on? Well, you default on the debt that you can discharge in bankruptcy, right? So,
nobody cares about credit card. Back in the day when you and I were growing up, if you didn't pay a credit card company, then you couldn't get credit for like 7 years. If you declared bankruptcy, it was like 10 years before anybody would give you credit. Now everybody's like a badge of honors. Oh, you filed bankruptcy? Oh, here's more credit.
Well, exactly. I know people who
cares.
have declared bankruptcy, and like literally the next day they're getting credit card. It's ridiculous.
Nobody cares.
But yeah, to your point, the pressure on the student loan side could actually manifest in higher delinquency rates in other types of debt. So important reminder that it's not dischargeable in bankruptcy. But what was interesting is another stat in the same survey. It was something like 45% said that they expect their loans to go delinquent when they go into repayment, where they're just, at least I took it as sort of like, I'm just not going to be able to pay them, right? Like I know at some point I'm just not going to be able to make these payments. I don't know if there was also an element in there of just like, hey, screw the government. If we all hold hands and don't pay, we can stick it to these bastards, right? And there's a lot of that going on in sort of, internet chat rooms and TikTok and stuff like that. So it'll be interesting to see. But as you and I have talked about, that's a pretty big risk because your opponent's the government and this stuff isn't dischargeable in bankruptcy. So, you could have a really unforgiving lender in this story.
Well,
But anyway, go ahead.
Yeah, just real fast. I mean, it was a really bad precedent that the government put out in the first place, saying, "Hey, we're going to forgive these loans and blah blah blah." Because again, it gave people hope that, oh, I took out, I've got 100,000 in student loan debt that I took out. I took it out. I signed the paperwork. I went to the classes. I did all that. That was all on me. And now the government's saying they're going to give it to me for free. That's awesome. That was just a bad precedent. If they were going to do this, they should have done it behind closed doors. They should have never announced it and made sure that it was all legal up front, and then say, okay, hey, we're going to forgive student loans.
Yeah, but now it shows you why this was such a politically motivated.
Yeah, but now you've created this whole environment where guys are going, again, I was like, we're going to hold hands and join in solidarity and all default on our loans at the same time. You're going to do so much financial damage to yourself. It's just sad. It was the same thing with people doing, what's the word? I forgot. Where people were basically basically pushing out their mortgage payments on their houses. And it wasn't a moratorium, but they were going through this whole premise like, oh, I'm going to negotiate with the bank and I'm not going to pay any mortgage payments for this period of time, and all that interest was accruing the whole time.
Right.
And this has just come back to bite these people terribly, in this but this is all part of what we created during that whole economic shutdown, and we just proliferated a whole bunch of bad financial policies for people, trying in the name of trying to help them, right? And again, I get why we did it. We were trying to help people that were in a spate of trouble because we shut down the economy. But human nature is oh great, I've got an ability to go spend money on something else that I want rather than paying my bills, and now it's all going to come home to roost at the worst possible time.
Yeah, and this, I had different rants, but at least a mini one here is, politically, I don't know exactly really when this started. Maybe it's been going on forever, but we have this almost sort of like policy creation process via hostage taking, right? Where we basically will have whichever administration's in power. I'm not trying to make this partisan because I think both sides are guilty of it. Okay. Well, they'll come out and they'll say, hey, we're announcing massive program X, right? And they get the public bought into it, and then they turn around to the opposition and say, well, of course now you've got to pass this thing because we have all these people that are now at risk, right? I'm probably going to get a lot of blowback for this, but with the Affordable Health Care Act, we expanded healthcare coverage to millions, tens of millions of people. From a heart perspective, very noble. These people, it's an essential benefit for them, right? But we had no plan how to pay for it, right? But we got the people insured, and then we basically turned around and said, okay, well, how are we going to finance this, right? And all of a sudden, anybody opposing that is against pulling healthcare away from these people. But it's like, wait a minute, no, you gave it to all of them without a plan, right? And now you're holding them hostage to us, so we've got to find some way to afford this, which of course it's not economically sustainable. And so we have to rack up more debt and tax more people and jack up rates for the people who are paying full freight. And again, I'm not trying to make it a partisan comment here, but we create this hostage and then try to figure out, how it's going to be debt funded, as opposed to saying, hey, what's a economically sustainable way to do the types of things we want to do?
Yeah, we spent hundreds of billions of dollars on those healthcare exchanges that all went bankrupt. We raised the cost on everybody that was healthy paying insurance. So now healthcare costs have risen dramatically. And ironically, the 20 million people that were supposed to get coverage still don't have coverage. So the whole premise never worked the way that it was said that it was going to work. It just raised healthcare costs. And to your point, we spent billions of dollars on stuff that now we have to wind up paying for. And we still haven't solved the problem, which is if you want to fix healthcare, you've got to fix tort reform. You've got to fix the medical billing practices. You've got to get government out of the middle of it. Again, when you put the government in the middle of anything, it's going to drive cost up. We can talk about student loans for that function.
Yeah, and efficiency down.
Yeah, and again, there are places where you pay cash for healthcare, and healthcare is extremely cheap. So, plastic surgery is a good example. Non-elective surgery, competition keeps prices down, quality of healthcare goes up. That's the model that we need to be implementing. $25 copays sound great, but it drives up the cost of healthcare for everybody. So there's very simple fixes, but we don't want to tackle those. It's just like fixing Social Security, right? Nobody wants to fix Social Security because nobody wants to do what's required to do it. But eventually it's going to fix itself because Social Security is going to run out of money. So we'll be forced to fix Social Security in a very painful manner at some point down the road, rather than doing very small fixes right now. Just raise the retirement age, increase contribution limits on Social Security payments instead of being capped at $137,000 and $400,000 of income. Everybody, no matter how much money you make, you pay into Social Security. Very small changes you can make that would bail out Social Security and Medicare and make it sustainable for decades. It's not sustainable long term because of the birth rate population, but we could certainly extend the year, extend it for 5 decades by small changes today that we're not willing to make.
No. All right. Well, look, you and I could rant about that, I'm sure, for another 3 hours.
Yeah.
I'm going to basically jettison everything else I have on the.
Just save it for next week. It's all good stuff.
Yeah, it's all going to next week. But of course, Lance, we got to talk about trades, right?
Yep.
Can't leave without talking about trades. What have you guys done, if anything, over the past week?
So we only did really some. So over the last during that whole correction process, we were talking about taking advantage of the correction to buy stuff, and so we did quite. We added to Apple and Microsoft and Google and those companies. So now we're down to the part of just kind of rejiggering balances within the portfolio to take advantage of opportunities. So this past week, we've owned AMD for quite some time. So we added Nvidia to our portfolio this week, or early on Monday. And then we added to our small regional banks this week. So we had bought back during the financial crisis back in March, if you want to call it that, the savings crisis, whatever. Back in March, we bought small starter positions in Truist Financial and PNC Bank, and we added just a little bit to those this week because they had a nice little run. They pulled back to support, and so we just added a little bit more, continuing to kind of build our position there. If interest rates come down, those banks are going to do very well.
Okay, great. All right. Well, look, in wrapping things up here, I want to remind folks that tickets are now on sale and selling fast for Wealthion's online fall conference on Saturday, October 21st. The faculty continues to just build out at a great, amazing pace. It's definitely the best faculty that we've ever had for one of these events. And if you've attended one of them, you really have a good sense of what I'm talking about here in terms of the high caliber of guests. Real quick, let me just run through the big names. We got Lacey Hunt kicking it off. He'll be delivering the keynote. If you've watched these in the past, you know that his keynote is worth the price of admission in and of itself. We'll have Jim Grant there, the godfather of interest rates. He'll be talking about where he sees them headed in 2024. We'll have Mike Kantrowitz there talking about the HOPE framework with a laser focus on the E element that Lance and I were talking about earlier in this conversation. We'll have Kyle Bass there talking about the biggest geopolitical risks that he thinks are going to impact the economy next year. Stephanie Pomboy will be back giving us her latest on how she sees the forces of inflation and deflation resolving. We'll have Ivy Zellman there talking about the housing market. There'll then be a reaction to Ivy's presentation from housing analysts Nick Jurley and Amy Nixon. We'll have Lance's partner in crime there, Michael Leibowitz, there giving us the latest outlook on bonds. We'll have Rick Rule giving his latest stock picks in the natural resources space. On the energy side, we'll have Doomberg there talking about the global energy situation. He'll be joined by Justin Hune of Uranium Insider to talk about the specific opportunities that are emerging in investing in nuclear. Of course, we'll have our advisors there like Lance and the guys from New Harbor and Jonathan Wellham from up there in Canada. We've got one or two other guests that we're landing right now. We're going to add some other big names to that list. But anyways, if that sounds of any interest to you, go to wealthion.com/conference. And you can learn more about the conference, but if you're interested, register soon because you can claim our deepest discount, which is the early bird price discount, which is about 30% off the full price for tickets. And if you've been an alumnus of one of our conferences in the past, check your email from me, because you'll have a discount code to get an additional 15% discount off of that 30% discount. And then just in wrapping up, as we do every week, highly recommend to navigate the environment that's most likely to be coming ahead, that you do so in combination with a financial advisor who understands and takes into account all the issues that Lance and I have talked about here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one, maybe even Lance and his team there at Real Investment Advice, then consider scheduling a free consultation with one of the financial advisors that Wealthion endorses. Just fill out the short form at wealthion.com, and we'll set one up for you. These consultations, they are totally free. There's no commitment to work with these guys, just a public service that people with golden hearts like Lance offer to help as many people as possible position as prudently as possible in advance of what may be coming. And if you enjoy Lance and I kicking back and having these conversations week after week after week after week, please let us know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, you get the last word, buddy.
Have a great Labor Day. Enjoy your weekend. Next week will be a shortened trading week, so we'll have less to talk about next week, right?
All right. Oh, I forgot to mention this too. Yeah, one of the things I was going to talk about was the importance of keeping play in your life. As folks are watching this when it releases on Saturday, I'm going to be at annually my funnest day of the year, which is the Gentlemen's Olympics, which is where I get together with a bunch of guys. We dress up in kind of old-timey clothes, and we do all these different kind of yard games, everything from, horseshoes to darts to bocce to pool to ping pong to axe throwing. So I'll have a lot to report from that when we come back on next week, Lance.
It sounds fun.
All right. Everyone else, have a great long holiday weekend. Thanks so much for another great week, Lance. Everyone else, thanks so much for watching.